If you're turning 71 soon, or your parents are, there's a hidden RRSP rule that could quietly cost you $89,000 in taxes. And the craziest part? Most Canadians find out only after the CRA sends the tax bill. Here's the truth. The RRSP you've been proudly building for decades, your nest egg, your security, your reward for saving, turns into a tax trap at age 71. Because by law, you must convert your RRSP into a RRIF before December 31st of the year you turn 71. If you don't, the entire balance becomes taxable income in 1 year. Imagine this. You've worked 40 years, built up a $400,000 RRSP, and you delay taking any withdrawals until 71 because everyone told you to let it grow tax deferred. Then one day you get hit with a $128,000 tax bill. Gone, instantly, because you waited too long. That's the hidden $89,000 mistake Canadians are making every single year. Let's break this down clearly. RRSPs were designed to defer taxes, not eliminate them. When you contribute, you get a deduction. When you withdraw, you pay tax, at whatever marginal rate you're in. The problem? Once you hit 71, you lose control over the timing. The government forces you to convert to a Registered Retirement Income Fund, RRIF, and begin mandatory withdrawals the next year, whether you need the money or not. And those mandatory withdrawals? They count as taxable income, which means they can push you into a higher tax bracket, trigger OAS clawbacks, reduce your GIS eligibility, and cost you tens of thousands over retirement. It's not a penalty. It's just math. Brutal, invisible, and entirely predictable if you don't plan ahead. Let's make it real. Say you're 65 right now, with $400,000 in your RRSP. You plan to let it grow until 71 because that AS when you bank is supposed to convert. Now the CRA says you have to convert that into a RRIF, and next year withdraw at least 5.28%. That's $28,300 taxable income in the first year alone. If you're already collecting CPP and OAS, that extra income pushes you into a higher marginal tax bracket. Your OAS starts clawing back at $90,997 of total income. At $120K, the clawback is complete. So not only are you paying more income tax, you're losing benefits you already qualified for. And here's the kicker. If you die with money left in your RRSP or RRF, your estate pays tax on the entire balance as income, unless it's transferred to a spouse. That means your $536,000 account could turn into just $360,000 after taxes. That's $176,000 lost to CRA. All because you waited too long to plan your withdrawals. Now let's compare that to someone who starts withdrawing early. Say, at age 65. You begin modest withdrawals, $20,000 a year, strategically keeping your income below the OAS clawback threshold. By the time you reach 71, you've already withdrawn $120,000 at low tax rates. Your RRSP balance is smaller, so your RRIF withdrawals are smaller. And you've effectively saved yourself between $72,000 and $89,000 in combined taxes and clawbacks over retirement. It's not about timing the market. It's about timing your withdrawals. Are you planning to wait until 71 before touching your RRSP? Type yes if you are, no if you're already drawing from it. I'll reply with your estimated tax exposure based on your age and balance. It takes 10 seconds, but could save you thousands. Up next, we'll break down exactly where the $89,000 loss comes from, how CRA tax brackets and OAS clawbacks compound the damage, and the simple withdrawal plan that could keep that money in your pocket instead of Ottawa's. Now let us unpack the math behind the $89,000 loss, because it's not one single mistake. It's a series of small decisions that compound over time and quietly drain your retirement savings. It starts with Canada's progressive tax system. The more you withdraw from your RRSP in a single year, the higher your marginal tax rate climbs. At low income levels, the rate might be 20%, but once your total taxable income passes $100,000, you're looking at 43%. Over $150,000, that can hit 48% in provinces like Ontario. Here's how that traps retirees. If you defer all withdrawals until age 71, your RRSP is larger, and every dollar you take out is taxed at the highest possible rate. But if you start early, say at 60 or 65, you can spread the withdrawals over more years, staying in a lower bracket. Let's compare two retirees, Emma and David. Emma is 65 with a $400,000 RRSP. She starts withdrawing $20,000 per year at a 22% marginal rate. Over 6 years, she withdraws $120,000, paying about $26,400 in total tax. David, same starting balance, same growth rate, but waits until 71. His RRSP grows to $536,000. When he starts mandatory RRIF withdrawals, his income spikes. Between CPP, OAS, and RRIF payments, he's now in the 43% bracket. His taxes on the same $120,000 over 6 years, $51,600. That's a $25,200 difference just from timing. But it gets worse. David's higher income triggers OAS clawbacks. Once your net income exceeds $90,997, the government claws back 15 cents of OAS for every dollar above that. David loses $30,600 per year in OAS he would have kept if his withdrawals were lower. Over 6 years, that's another $21,600 gone. Now add in investment growth taxation after 71. Your RRIF withdrawals push your income higher, which can reduce tax credits and increase your effective tax rate even more. That's how the total loss compounds to $70,000, $89,000 for the average retiree who delays too long. Most people don't realize this because they see their RRSP as tax-free growth. But the truth is, it's tax-postponed growth. The CRA is your silent partner. They just let you decide when to give them their share, until age 71. After that, you lose control completely. There's another hidden cost, something most advisors never mention. Once you're forced into RRIF withdrawals, you can't recontribute that money to a TFSA unless you have contribution room. If you withdraw $30,000 and only have $7,000 of TFSA space, $23,000 stays exposed to tax forever. If you had started earlier, you could have funneled smaller withdrawals into your TFSA annually, protecting more income from future taxation. The difference between smart planning and blind deferral can literally decide whether your retirement income lasts to 90 or runs out at 82. And this mistake is everywhere. According to CRA data, over 52% of Canadians aged 70 have not made a single RRSP withdrawal yet. By waiting until the conversion deadline, they guarantee higher taxes, higher clawbacks, and fewer options. It's not just about numbers, it's about control. Early withdrawals mean flexibility. You can manage your income. You can avoid the OAS clawback zone. You can reduce the tax hit on your estate later. Waiting until 71 means you're gambling that future tax rules, rates, and benefits will somehow favor you. And they rarely do. So the $89,000 mistake isn't a one-time error. It's death by 1,000 deferrals. Before we move on, quick check. How old are you right now? And what's your RRSP balance? Drop both numbers in the comments. I'll calculate your personalized tax difference between withdrawing at 65 versus 71 using CRA 8's current 2026 brackets. Next, we'll walk through a step-by-step withdrawal strategy that minimizes taxes, avoids clawbacks, and maximizes your after-tax income in retirement. It's not complicated, but most Canadians never hear it until it's too late. Now let's talk about the solution. How to avoid the $89,000 mistake before it happens. The good news is this. You don't need a financial advisor charging 1% of assets every year to fix this. You just need to understand how RRSP withdrawals interact with tax brackets, OAS clawbacks, and government benefits, and then plan a few years ahead. Step 1. Start withdrawals early, even if you don't need the money. Between ages 60 and 70, your marginal tax rate is often the lowest it will ever be, especially if you're retired but not yet collecting CPP or OAS. Use that window to draw down your RRSP strategically. Example, withdraw $15,000 per year from 60 to 70. That keeps you in a low bracket. around 22%, avoids OAS clawbacks later, and reduces the size of your RRIF before mandatory withdrawals begin. The smaller your RRIF, the smaller your forced taxable withdrawals, and the lower your taxes in your 70s and 80s. Step 2. Use your TFSA as your RRSP drain valve. Each time you withdraw from your RRSP, move part of it into your TFSA. That way, it continues to grow tax-free, and you can withdraw it later with zero impact on your taxable income or OAS eligibility. If you start this process at 60, you can shift over $100,000 into your TFSA by 71, assuming average annual contribution limits and growth. That's $100,000 permanently shielded from future taxation. Step 3. Coordinate withdrawals with CPP and OAS timing. If you delay CPP or OAS until 70, you gain up to 42% more in benefits later, and you create more low-income years between 60 and 70 to draw down your RRSP at lower tax rates. That's the sweet spot. The combination of early RRSP withdrawals and delayed benefits creates an ideal tax balance across retirement. Let's put that all together with a real-world scenario. 2 retirees, both age 60, both with $400,000 in RRSPs. Retiree A, the deferrer. Retiree B, the planner. Starts withdrawals at 60, moves money into TFSA annually, delays CPP and OAS to 70. That's a difference of $89,000, the same number we've been talking about since the start. And it's not luck, it's just strategy. You don't need to guess. The CRA publishes all the data you need to run these calculations yourself. You can even model your withdrawals using the government S-free RRIF calculator or the retirement income estimator on the CRA website. Here's your action plan for this week. 1. Log into your CRA My Account. 2. Check your RRSP balance and contribution history. 3. Estimate your tax bracket and OAS clawback zone. 4. Run a withdrawal scenario from ages 60 to 71. 5. Identify how much you can draw each year without crossing into the clawback threshold. If you want, drop your age, RRSP balance, and province in the comments. I'll calculate your ideal withdrawal amount to minimize taxes in 2026 using current CRA data. Don't let this be another policy that quietly drains your savings. The RRSP was designed to help you retire comfortably, not surprise you with an unexpected tax bill at the end. Plan now, adjust early, and keep that $89,000 working for you. Not for Ottawa,